Hello sector watchers, welcome to the show. This is the 206th episode of Sector Spotlight for Tuesday the 6th of February 2024. My name is Julius and I am presenting to you from Amsterdam in the Netherlands. It is the first week of the month and that means that we're going to take a look at what happened in the monthly time frames, both on the RRG and the price charts for asset classes and sectors. And let's start with the RRG, the monthly RRG for asset classes. As usual, the tail of Bitcoin is completely wrecking this image, distorting it because it's so strong and so long. So I'm going to take it off. We all know that Bitcoin is a very strong asset class at the moment, has been for the last couple of months, and it's moving further into the leading quadrant, indicating further outperformance in the coming months in this case. So I'm going to take that away and fit the chart. And then we got a better handle of what's going on. You see the commodity ETFs, GSG and DJP, moving into the lagging quadrant, and the US dollar is following suit. They are picking up a bit of relative momentum, but the direction of the relative trend is to the left. It's moving lower on the RS ratio scale, and that means a continuing underperformance versus VBINX. If I'm gonna take those away, so the US dollar, DJP and GSG, then I get a clear picture of what's going on in the relationship between stocks and bonds. And what you see here is a very clear preference for the stock market. SPY is rotating back into the leading quadrant. If you look at the rotation of that tail, it's coming out of weakening and it has recently, a couple of months ago, moved back into the leading quadrant. And it continues to pick up relative strength on the RS ratio scale. The opposite is true for all three of the fixed income asset classes. So we've got high yield, government bonds and corporate bonds. They're all moving in a negative direction, a negative heading. Corporate bonds and government bonds are already inside the lagging quadrant, and high yield is working its way towards that lagging quadrant. So the main takeaway for this RRG and for this monthly rotational picture is that there is still a very clear preference for stocks over bonds in the longer term. Now be careful, that doesn't necessarily mean that stock prices will continue to go up. It is very well possible that SPY moves into the leading quadrant while stock prices are going down and bond prices are going down even faster. I'm not saying that it's going to happen, but we are at relatively high levels, extended levels, so the risk of some sort of a correction is increasing. At least I'm watching it really closely. I don't see any evidence right now, but please be aware of the fact that an RRG shows you the relative picture. So even when stock prices go down, they can end up inside the leading quadrant when bond prices are going down even faster. That's the most important thing that you need to be aware of. We're going to take a look at those individual price charts in a minute. So starting with the S&P 500, you can see, you all know we broke to new highs. We're still holding up very well above those levels. By the way, I did change my setup slightly. I made all the charts log charts, log scale, so you won't see any angled trend lines anymore on my monthly charts, only horizontal levels. And I've cleaned everything up, so there's a lot less annotations than there used to be, because my modus operandi is that a lot of my lines stay on there, and then after a while the chart becomes a mess. So started a new year, started a new month, seems to be a good moment to clean up your charts and get rid of all that annotations that are were months old and not really applicable anymore. For the S&P 500, this trend is still up, so we've got that labeled as up. We go to government bonds, and as I said, I've cleaned it up. This downtrend here is very clearly in play. We've got a nice rally here, but the series of lower highs and lower lows is definitely intact. And that is a bit contradictory to what's happening in stocks. Usually you would see them moving in tandem, and that's not the case at the moment. So you've got to be aware of that, and I think that probably the biggest risk for the stock market right now is a real rapid rise in interest rates. If that happens, that could be the catalyst for some sort of a decline in the stock market. Again, it's not really happening right now, but just put that in the back of your head, as at least keep it in the back of your mind as a possibility. I think that's the best way to classify that. So IEF's got a little bit more history. Got the same story here. You see that move down. You see the lower highs, lower lows in place. Trend still down, however, well off the low. So this rally here has pushed yields down a little bit, and that has helped the stock market for sure. And here is corporate bonds, LQD, found support around 98 something. And actually we could be building a big double bottom here. So I'm watching 112.5 in LQD as a potential trigger. If that is taken out, that will definitely trigger more upside potential in corporate bonds, which could be a good diversifier in your portfolio. We go to high yield. We got kind of similar. It looks as if we're a little bit further ahead than LQD in the attempt to complete this double bottom. Not really double bottom, but at least start a new series of higher highs, higher lows. We need a little bit more, but then there is quite a bit of room for HYG to actually accelerate to higher levels. And then we've got both commodity ETFs. That long turnaround is still there, and you can see on this monthly chart how we are finding support around 29. That seems to be a well-respected level for DJP. This low here is slightly higher, but then we've got the cluster of highs here. We've got this high here, and then we've got obviously that low in May, and now we're very close to that level. If this low breaks, so if DJP breaks below 29.15, that would be a pretty seriously negative sign for commodities. Not sure what the catalyst would be or could be for that, but it's something that I'm watching. So 29 in DJP is definitely a level to watch. And then we go to GSG, kind of a similar chart here. The level here is around 19, 18, 70. Again, also well respected. Lows here, a bit of a touch of resistance here. Twice tested as resistance here, broke it, and now it came back as support, and it looks as if we're going there again. In order for these long-term trend turnarounds to continue and to actually materialize, I think that both commodity ETFs should stay above their previous lows. Otherwise, we'll get a completely new scenario with way more downside for commodities. And then the US dollar, longer term, that break is still there. It keeps testing that 100 level and then bouncing off of it. So that is becoming a stronger and stronger support level, 100 in the US dollar index. And we're now on the way to, I think we're on the way to the area around 105, 106 again. So upside for the US dollar. What you can see in the RRG, you saw that the US dollar is moving into the lagging quadrant, picking up a little bit of momentum. But it's not completely fair because we're comparing the US dollar to VBINX, which is a stock and bond benchmark. So if you look at the price chart of the US dollar as we're doing right now, I think it's in way better shape than the relative position versus VBINX, which we see on the RRG, is actually suggesting. Finally, we've got Bitcoin, still on the way up. We have this massive overhead resistance around 48,000, 48.5. It's quite a wide range. That is where we bounced. We came off of it. We're stabilizing, consolidating right now. I think if Bitcoin is able to take out 48K in the next 1 to 3 months, the next step will be a test of 65,000. I don't have to explain to you what happens if Bitcoin takes out 65, 66,000. So the outlook for Bitcoin and crypto in general, based off of this proxy, is actually pretty strong for the next couple of months, in my opinion. And then we move over to the monthly RRG for sectors. And when you look at this, you can see a continued outperformance or positive rotation for both technology and communication services. Communication services actually only just moved into the leading quadrant. Technology is already there. Both are losing a bit of relative momentum, but they are both moving higher on the RS ratio scale. So they're still picking up in terms of relative trend. The complete opposite goes for energy, which is now starting to come very close to crossing over into the lagging quadrant. And this is very clear indication for the continued underperformance as we've seen it over the last months for the energy sector. And it looks as if that's still going to continue. And if I zoom in on this group of sectors here inside lagging and just about into weakening, you can see that they pretty much all move into that negative heading. So energy is down there, and then here is industrials. We got utilities, we got real estate is the lowest reading on the RS ratio scale. It's picking up a bit of momentum, but it's still moving to the left, so there's not much good there. Then we've got staples moving straight down into the lagging quadrant, suggesting a further underperformance. And then we've got healthcare still moving lower, picking up a bit of momentum. So those are these defensive sectors, healthcare, staples, and utilities. Although there is a bit of a debate, you could bring up that there are now, the question is healthcare still a purely defensive play? There are quite a few aggressive growth companies inside that healthcare sector. So I think the jury is still out there. I continue to reference to it as a defensive sector, but you can see how it's now diverging a bit from utilities and staples, and those are definitely defensive sectors. We got financials picking up. We saw that on the weekly a couple of weeks ago already, and here you see materials is continuing further down into the lagging quadrant. So this long-term rotation, as it's painted here by that monthly RRG, is pretty much still in favor of growth stocks, I would say. So you got communication services, tech, consumer discretionary to a degree, moving there to the right, and then we've got definitely utilities and staples moving into the lagging quadrant. So all in all, that is still a pretty constructive rotation. Let me quickly bring up the equal weight version of these sectors to look at the longer term rotation with the mega cap, the large cap effect taken out of this equation. And you can see that there is a lot of similarities, but also quite a bit of discrepancies. You see that technology and communication services is way to the left, so it's got a long way to go. And here you see that N is industrials and discretionary are inside the leading quadrant. They're losing relative momentum, but still moving to the right. Here you see energy pretty much in line, not as strongly negative as on the cap weighted. But here you see staples and utilities. Those are moving steeply into the lagging quadrant. And then we've got materials, and here's healthcare. That's an interesting tail. Let me highlight that healthcare tail. That is moving straight into the lagging quadrant. So we saw that cap-weighted version picking up, and here it's a very clear negative rotation for the healthcare sector. So what this tells me is that the large cap sector, the large cap stocks inside the healthcare sector are actually dragging that XLV tail upward, whereas the equal weight version is very clearly moving lower. And now we've got real estate and financials, very low readings, but they are picking up. They are starting to improve, but they still have a long way to go. So that's the takeaway for these long-term sector rotations. Let's now take a look at their individual charts. Let's start with the communication services sector. And as you know, we're using the indices here, not the ETFs, not the spiders, but the underlying indices. And here, all these charts are now log scale, semi-log scale. So no angled trend lines anymore, just the horizontal levels, labeling of the trend. And here you can see how communication services continues its move higher on its way to, let's say, around 290, levels around 290. That trend is very clearly up. We go to consumer discretionary, it is also up. We see higher highs and higher lows, although the pace and the angle is a lot slower than for communication services. And we are pretty close to the next resistance level, which is around 1510. Nevertheless, the trend here is still up. That's a good sector, it's an important sector, and the trend is up. So that's good news for the market, in my opinion. Consumer staples, we saw that it is moving into the lagging quadrant on the RRG, and that's because it's a relative underperformance. Well, if you look at the chart here, you can see how staples have been trading in that range for more than 2 years now. So if you move in a range while your benchmark is going higher, obviously you end up inside the lagging quadrant as an underperformer, and that's exactly what's happening with the consumer staples sector. So the levels to watch here is around 690 and about 809, 810, something like that. This is a neutral trend, by the way. Don't worry, I'm gonna give you the summary of all these trends, etc., in the table as we usually do that. So you don't have to take notes. The energy sector, quite similar, touching to all-time highs. All-time highs were already set back in 2014. We touched them, but we haven't been able to take them out, and we're now moving in a sideways range. This is a neutral range for the energy sector. Here is financials. Again, it's breaking out of that range. That was 2 months ago. So that trend is now up. You see higher highs and higher lows. And the next level to watch is this here. That's around 700, around at 700 is the next target. And the former resistance is now acting as support. So the risk to the downside is actually quite low. Here, the healthcare sector, interesting sector, and it's pushing against all-time highs. But here also you see why it is inside the lagging quadrant and losing relative strength. Because here also, this is like, I don't know, 1, 2, 3 years, roughly 3 years of sideways movement of a sector while the market has been going higher. So that is clearly an underperformer. But that can all change when the healthcare sector is able to take out that overhead resistance, which is around 1670, 1675. Support is nearby at the previous highs that now are expected to act as support. That's around 1595. For the time being, I'm labeling this trend as neutral until we break that former all-time high and unlock new upside potential. Here's the industrial sector. Despite the fact that it's not the strongest in terms of relative strength and on the RRG, but we did break to new highs, and we're, this is the first few days of February, so this is January, this is December. So in December we put in a new high and a new closing high. That was consolidated in January, and we're now continuing to push higher. So the industrial sector is actually warming up quite well right now. The price trend is definitely up, higher highs and higher lows. The pace needs a little bit of work. The angle of acceleration could improve, but the trend is definitely higher. And then here is information technology that doesn't need a lot of clarification. Breaking to new highs, closing highs, holding up very well above those breakout levels, and continuing to move higher, making it the best sector at the moment in terms of price chart here. The strongest break, best consolidation, holding up above that breakout level, and the former high here, that's around, I don't know, 32.82. That should be a support level in case of a setback. I mean, look at this chart. It wouldn't be strange if this market would come back and put in some sort of a consolidation, but that's why I like to look at these monthly charts, these long-term trends, because there is absolutely nothing wrong with this trend. I hope you agree with me on that. And then we've got materials. In a range, the range is getting narrower, so we've labeled this trend as neutral, and it's now between, say, 470 and 540. Highs at the same level, lows at the same level. We've got to wait and see which side materials will break out of this range and continue in that direction. And then we got real estate. It came out of a clear downtrend. It's now neutral because we did take out the previous high, so the rhythm of lower highs and lower lows has been distorted. That's gone now. So we are neutral, but there is still a lot of overhead resistance. Good support around the 200, 205 area, I believe. And then here is utilities, and that is the only sector in the S&P 500 that is in a very clear downtrend. Lower highs and lower lows. That's what it is. Good support around 295 with a spike here to 280, 278, 280. And the next resistance level to watch is around 335, 336. Only if we can take that out, utilities will go back into an uptrend. With this type of trend ongoing and the uptrends in all the other sectors, I think that that'll be a hard thing to actually happen. And then here, finally, this is the S&P chart. We already looked at that when we looked at asset classes. And then wrapping up the overview of sectors, the monthly sector charts. You see the prices, you see the month-to-month change. We're looking at the completed bars of January 24. Relative performance, strong for communication services, financials, healthcare, and technology. S&P up 1.6, and the rest in terms of price changes are quite mixed. There is only one sector, the technology sector, as well as the S&P 500, that made a new all-time high, as well as a new closing high. And then if we look at trends, we've got 5 sectors in an uptrend, 5 sectors in a downtrend, and 1 in a downtrend. Sorry, 5 in a neutral trend, 1 in a downtrend. And that translates into 65.9% of market capitalization, not 65.9% of the sectors. 65.9% of the market capitalization of the S&P 500 is in an uptrend. 31.2 is neutral, and 2.9 is in a downtrend. Overall, I think this is still a pretty healthy constellation, pretty healthy structure for the market. There's always a risk of a bit of a decline, but with this kind of outlook, with these kinds of trends on the monthly charts, I don't see a landslide coming up upon us. I just don't see it. Anyway, here are the support and resistance levels, the downside risk, the upside potential. Very decent risk-reward potential for most of these sectors. You can look at the overview. This chart list is a shared chart list, so you can actually look at those charts. I'm not sure if I can share this spreadsheet one way or another, but if I can, I will do that, and I will let you know. And that wraps up Sector Spotlight for this week. Thank you for watching. I hope you enjoyed the show. Please remember, Sector Spotlight is available on demand on the Stock Charts YouTube channel, usually recorded and uploaded on Mondays. Feel free to share your thoughts and ideas in the comments below the video. I'll watch them and I'll respond to them. Looking forward to seeing you again at a new episode of Sector Spotlight next week, same time, same place.